Hi guys, here's Hustle Hub. On today's spiel, we're going to talk about SPACs. But before we get started, remember to subscribe to the channel, smash the like button and turn on the notification bell. Lately, in the news we have heard about SPAC listings and big hedge fund managers starting these new investment vehicles. But what are they exactly? SPAC stands for Special Purpose Acquisition Company. They are also called blank check companies or even blank checks by themselves. The company starts with an initial public offering where it raises capital. If you don't know what an IPO is, check the video we made about it. SPACs are different compared to other types of companies because usually a normal company starts private, and once it grows, it can later decide whether to go public or not, and it is a way to raise capital in the moment of the IPO. Later, raising further capital, it will be even easier because public companies have to disclose more about their performance so that the investors can get in with less risk. SPACs instead are companies that start out by going public and raising capital on the markets. Once the capital has raised, the management will have to allocate it by buying privately held companies. Investors in the SPACs receive the stock that they purchased on the market, plus a warrant, which is an option to buy the stock in the future at a previously fixed price. So, if the value of the stock grows, the investor will have the possibility to buy more at the fixed price and then sell on the open market for the full price. But if the management of the SPAC doesn't find anything to allocate the capital, the money will be returned to the investors, usually within 2 years. But we have to point out that most of the time, SPACs are more risky than traditional IPOs, because in the traditional ones, we know more about the businesses we're about to invest in, while the SPACs don't have a business at all when they're starting out. That's why they are also called blank check companies. Furthermore, in traditional IPOs, there's a lot more scrutiny than in SPACs IPOs, because the first ones have to be approved by the market authorities, like the Securities and Exchange Commission. Another thing is the difference between investors' interests and management interests. Management almost always has the option to buy shares in the company at an extremely discounted price. These companies are always started by people that are already very well known in the business area. Let us give you some names. For example, we have hedge fund manager Bill Ackman. Then we have Tilman Fertitta, owner of the Houston Rockets NBA team. Reid Hoffman, founder of LinkedIn. Marcus Pincus, founder of Zynga. And Chamath Palihapitiya, former Facebook manager and notorious venture capital investor. And then Masayoshi Son, founder of SoftBank. In the case of Chamath's SPAC, investors got 80% of the company by paying $10 per share, while he got 20% at 2 cents per share, so the investors got their capital diluted. In the US jurisdiction, investors can vote whether to proceed or block an acquisition. This does not happen in other countries like the UK. Even though they're picking up some space lately, SPACs have existed for lots of years, but a Bloomberg opinion pointed out that SPACs IPOs generally underperform typical IPOs' performance. But when there is excitement in the market, it is easier to raise capital, and these managers are taking advantage of the market environment and capitalize off it. Well, thank you guys for watching the video, and remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. See you next time with another video for you. This is Hustle Hub.